Good afternoon, everyone. You're all very welcome to another US market open here. Obviously, today, Tuesday, we have inflation day in the US, recapping and looking at the volatility and price action, of course, into today's obviously US session open in the wake of the CPI numbers. So, firstly and foremost, let's have a look at the data that came out of 1:30, right? So, cross asset perspective, we know we talked about this morning in our community. The change in the weighting of the calculations, firstly, the change of the composition of the data, secondly, and how that would be interpreted by analysts of institutions and, of course, by markets and traders, broadly speaking. So, of course, the first thing we're kind of focusing on today is where was the data in January and where are we currently at? Now, if we look at any of, I suppose, the 5 or 6 major inflation levels, whether it's month on month, year on year, core inflation levels, we can actually see broadly across the board that the inflation after this revision, after this recalculation per se, is actually still remaining quite high. Okay, so that's really the general theme coming from today's data. If we look at previous figures, 6.5 and 5.7 year on year, both core and headline, you can see that's obviously playing out. The narrative today was for the expectation of a slightly reduced figure, 5.5 and 6.2 respectively was the consensus. That's what markets were forecasting. And of course, we came out slightly above that. So it shows that, yes, the composition of the inflation index is obviously quite important, and those subtle changes in the index is paramount. But also, where are we in the broader dynamic of the markets? Okay, we saw it and we look at the price action in a second with volatility on both sides of the coin, and both sides of the order flow today. And it's important to be uniquely aware of that as well. Now, broadly speaking, as an individual who looks at the markets daily, I suppose the first clear thing is that the inflation is still remaining quite high, right? We're not seeing that continued reduction. We saw very, very sustainable drops, 0.5, 0.6% in November, in December, in January compared to previous months. But of course, in February, this data is now only coming down marginally, right? We talked about it, the Fed, what did it do in the first week of February? It raised rates by 25 basis points, looking for that continuous raise in March. And now, if we see inflation still remaining at this 5.5, 6% levels on the different inflation metrics, that's probably going to mean we're going to get another 25 basis points in March as well. And really kicking the can down the road for this so-called pivot in terms of a change in policy where we start to reduce the rates. Now, of course, the Fed have said all along, quite frankly, from last autumn, that they're going to remain as high as possible until they see these inflation levels continuously coming down at a fairly sharp degree. And at this moment in time, yes, November, December, January, we saw fairly significant declines, but it wasn't enough. They're looking for that to be sustained, looking for that to be a little bit more systemic in the next couple of months, into March, into April, and of course into the early parts of the summer as well. So at this moment in time, I don't think you're seeing that much in terms of a change in Fed policy because of course, as market participants, we're forward looking. Okay. And I think that's quite important as well to say, well, are we going to get that reduction or reducing of interest rates in the back end of the year? Well, if inflation remains above 5.5% and above 6% on the headline, well, then the likelihood is no, that you're not going to see interest rates really reduce until either the very, very end of the year at a peak or at the earliest, or the likelihood is of 2024. So I suppose the inflation levels, the CPI, the PCE, of course, are going to become very, very important pieces of information and data over the next 2 to 3 months. Because, of course, if the inflation and if these data points aren't coming down significantly, consistently, then, of course, that means that they're going to have to keep those rates higher for longer, which, of course, is a bearish thing, which, of course, potentially means we're bringing selling back into the markets. And when we mean by markets, we're talking about the stock markets and, of course, those risk assets. So, of course, we've seen the dollar weaken in previous weeks. We saw a little bit of a pullback, obviously, last week. But, of course, how does that factor into the price action? Well, let's look at the broader markets today in the back of the data of 1:30, right? What's the first thing we've seen? Well, if you look at the order flow, you look at market makers, the first thing we saw at 1:30 was that initial move to the downside, followed by the initial move to the upside. So within 3 minutes, this daily range that we had effectively held all morning was broken on both sides, right? So that's important to identify the activity of market makers, of liquidity providers in the markets, because, of course, when you see systemic moves lower and higher, or higher and lower almost at the same time, that's a taking of liquidity. That's market makers taking volume out of the markets, orders, stop hunting, only to then try and pave the way. And since then, we've come all the way back into this value level here in euro dollar and a subsequent decline. Now, of course, I think what you're really going to see is, will this pressure, because the inflation figures were higher than expected, which is a net negative thing for risk assets. So you're thinking euro, you're thinking indices, anything with a risk composition associated with maybe even gold, cryptos as well. How is that going to play out? Because of course, at this present time, those types of figures today, 6.4, 5.6 month on month, at coming in at 0.5 and 0.4 respectively, is not going to instill massive confidence, because of course that means the analysts then are going to have to say, well, the likelihood is March is going to be 25, May is going to be 25, continue the rate hikes for at least another few months anyway, then obviously a suspended pause potentially for maybe 6 months, and then potentially then will we start to see rates coming down at the back end of Q4. All of those things are becoming a little bit more unlikely, because of course these figures are remaining higher than expected. And that's really then why we're starting to see those pairs, these risk assets, starting to filter lower into 230. We're starting to see that selling following that kind of taking of liquidity on both sides of 130. And I think that's why it's important we tell traders to be calm rather than chasing the markets willy-nilly at 130, buying and selling. Give the markets time to breathe, because often what you see is the algos taking the markets up and down, and of course avoiding that liquidity is ultimately very, very important. We saw a very, very similar thing here on cable. You only have to look at the 15-minute candles just for a second to see the volatility on both sides, close margin lower. We're starting to see the true effect coming in here in pound dollar as well, and we're starting to see those markets drift on the fundamental factor that the inflation was higher than expected, which, as we said, is a net negative for risk assets. Now, of course, if we look at gold, very, very similar scenario. Gold rallied very, very sharply, followed by that kind of incremental increase. Of course, you can see it here as well. Very, very sharp move to the downside, followed by immediate recovery. And now we're starting to see the true move actually play out after the initial impulses at 130. And I suppose that's really the important thing is now, can we start to break these initial moves that we saw 130, breaking of 130 lows really could potentially bring in further selling into 230, of course, into 3 p.m. today as well, which is, of course, what market participants are now looking for, broadly speaking. So we want to see, is there a break through these structured lows? And of course, that gives us a little bit of a clearer dynamic from 230 then into 3 p.m. Now, indices, again, very, very similar narrative here. Very, very clear impulse to the upside, all the way back down. So we're starting to see that risk orientation, cyclical reversion. I'm sure if we look at the VIX, you'll see the VIX up marginally, and of course the indices down as well. So you're starting to see that play out very, very clearly. Similarly, again in the Nasdaq, very, very clear impulse all the way back up to the liquidity level. Now, me personally, I even had an order in here in the Nasdaq at 620, which got filled perfectly. And of course now we're running this lower, right? So looking to see kind of where and what is the consensus into 230? Does this selling become a little bit more widespread? And if so, can we start to see these indices run off against what's been a very, very positive couple of weeks? And you only have to look at the Nasdaq since the early mid parts of January, latter parts of January, and of course the S&Ps, broadly speaking, from the current dynamic of where we were just a few weeks ago, way down here at 3,900, 3,950. Now, of course, we've seen a fairly significant recovery on Friday from this low down here at 4,050, 4,060. It'll be interesting to see, does the market sell off again back into these structural levels? So looking at the price action can give us a fairly good idea, once the dust settles, of where the price action is probably going to go in terms of the next move, and then being able to adjust that within the lower time frames to give us a clearer dynamic of price action, broadly speaking. So let's look at then the market profiles into 230. Okay, so we've obviously had that manipulation. Even the deep prints is the exact telltale sign. Deep prints is 130, taking of lows all the way back up, right? All the way back down into the value area, and is now starting to move lower out of the value range. So this range here between 4,130 and 4,150 was the value area, was the range. We've broken back underneath POCs, and the markets are extending to the downside. So that's really kind of insinuating to us, short-term perspective, if you look at 5s, you look at 15s, that indices are going to struggle into the open. And of course, when you play it out, when you look at the broader price action, you can see that playing out very, very clearly into 230. So as we approach 230 now in the next 30 seconds or so, we're now looking to see, does that sell-off become a little bit more widespread? And do we start to see the true reflection of the price action following the digested moves at 130 from the economic data? And that's really what's important here. We're separating the wood from the trees. We're identifying the fundamentals, firstly, understanding what the data is. We're less focused on the short-term initial volatility at 130, because we know it's going to probably go both ways, which it tends to do 90% of the time. But we're looking for the clearer reflected moves in the price action, and we're looking to take advantage of those. Very, very simple in the broader sense of that. Now, NASDAQ. If we look at the NASDAQ into today's open as well, of course, what are we seeing on the NASDAQ? Very, very similar scenario. Of course, we had that massive spike all the way up into this level. I did get triggered up here above a kind of 620 on NAS. Now, it did get slightly higher than that, but that's okay. That's fine because, of course, we've seen that very, very clear erosion to the downside. NASDAQ, obviously a more volatile asset. When things go negative or when the sentiment changes and we see that shift from risk on to risk off, the NASDAQ tends to get hit the most. Of course, why is that? Because it's the index that's most affected by negativity in the markets. Why? Because of its tech composition. So it's important to understand that dynamic. Now, of course, as we look at the minute, NASDAQ is continuing to move very, very significantly to the downside. And you can even see it here, 380s, 400s has now been broken after a very, very clear impulse at 620, 640 from up here. So that's obviously quite evident as well. So when we look at the broader perspective now at 2:30, as markets are opening, we're seeing that sell-off. We're seeing the NASDAQ drift lower initially, right? We're seeing the S&Ps drift lower quite significantly. We've gone from 41.20 at 2:30 all the way down to 41.08. So there's a 12-point movement already in the NASDAQ or in the S&Ps. Similarly, again, in the NASDAQ, we've gone from 430s approximately down into 360s. So we expected a little bit of fireworks at 2:30. We're really getting that playing out. We're really getting the selling coming through now. And it really becomes a case of how far or how elongated does this sell-off come in, given the reaction that we saw at 1:30. And I suppose that's the really important thing now is that the initial elements have been shown. The data is obviously worse than expected. And we're now looking to see, does that bearish sentiment come in after all of the liquidity has been taken? And of course, we had the initial liquidity in euro dollar. We had initial liquidity in cable, as we talked about. With initial liquidity in gold, we talked about. But we're seeing these risk assets migrate to the downside. And of course, with risk assets migrating to the downside, we're seeing the DXY in that rotational play pick up fairly significant strength. And the dollar currency index in the last hour or so has gone from 102.50, 102.75 at these structured lows down here, all the way back up. So we're seeing that rotation in sentiment from stronger or weaker dollar into stronger dollar, euro, USD, GBP, USD, gold, indices, all very much taken to the downside. And it becomes a case of how long does that play out for? Well, you're probably going to see it for into 3 o'clock. I think that's going to be the initial impulse. But I think what's crucial now is, does the sell-off extend beyond 3:30? If we see that sell-off extended beyond 3:30, you're probably going to get a negative close in the day, and you're probably going to see a fairly significant move into tonight's close at 9 o'clock. And I suppose that's how we understand the shorter-term movements in price action from the deeper moves that generally occur through the course of a trading session. All right. So as we speak at 2:30, risk sentiment is very much off the table. We've gone very much back into the rotational safe haven play. We're seeing the dollar pick up steam. We're seeing the FX pairs move lower in favor of the dollar. We're seeing obviously gold move lower. And of course, we're seeing the indices move lower as well as the S&P comes back into 4100. Similar scenario on Wall Street is again, very, very clear taking of liquidity to the upside and almost turns on a dime and a U-turn all the way back into this previous range. And of course, now with Dow Jones, Wall Street, we do tend to recommend traders to say, well, in times of volatility, stick with the S&Ps. You have more traded volume. You can hit it with a better position size or a higher position size, and obviously tighter stops and compared to obviously Wall Street, Dow Jones as well. So, of course, all eyes is really on the price action at 3 o'clock to see whether this sell-off sustains. And more broadly, how does it reflect come 4:30 as we approach the European close as well? But obviously, as we speak at this minute, risk assets very much in the backbone following obviously higher than expected inflation figures. All right, trade safe, everyone. We will be back tonight. Of course, I will be back at 8 o'clock tonight to run through the markets following today's CPI as well, just to give a reflection of the price action into tonight's close. And of course, looking ahead to some of the major teams and events through the rest of the week as well. So of course, we will be filtering that Zoom link out to our community this afternoon as well.